Hey everyone, welcome to another edition of the Buddy Study Group for Worksite Solutions. And today we're going to bring it back to last year and bring back our Ask Me Anything About Group Long-Term Care session. So this is really an opportunity, open door, no silly questions to be able to ask whatever's on your mind with regard to group long-term care, be it case related, be it general questions. Anything you want, you've got access to get your questions answered today. I thought this went pretty well last year, and I looked to the last time we did it. It was just around a year ago. So let's bring it back. Now, when I sent out the agenda, I did um, ask folks whether they would be on the call or not to send me some questions via email if they had any, and I would start with answering those live. So I did get a couple questions. I got a couple really good questions. So I guess we'll start with that. Keep your questions in mind. I'll open it up to everybody to be able to ask whatever questions they have as we go through. Once we're through with those, we'll get to them. So the first question that I got is how are premiums generally paid? And I actually had to get clarification on this because it is premium that can be paid by employees and it's premium that can be paid by employers. So um, I asked for clarification and they said, I guess both. So we'll do both. So for employees, premiums are generally paid two ways. Okay. I think there's benefits and drawbacks to each for everyone involved. Um, ACH, which is just the employee pays with their individual checking account, that one's becoming more popular than ever, I would say, for a number of reasons. But um, the tried and true way that premiums are paid by employees, or at least kind of the tale as old as time, is payroll deduction. So payroll deduction is a deduction from the employee's paycheck directly for the premiums paid for the plan, right? And I think with payroll deduction, there's absolutely no way that there is going to be a missed premium, right? When you think about ACH paying from a checking account, you in a very rare case, you might have some sort of overdraw or the client, the employee, changes banks and transfers to another account and clears out that existing checking account. I think those are few and far between. Uh, an employee is always going to receive their paycheck, so the carrier is always going to get their premium. Now, I think where ACH may have the upper hand is when it comes to portability. Now we know not all group benefits are portable. This is the real reason that ACH is so hot is because the group long-term care plans that are out there today are all portable. If you retire, if you leave your employer for any reason, you're fired, you find a new job, whatever it may be, because you're hooked up to that bank account, you don't have to do any work in order to retain that plan. With payroll deduction, when the employee leaves or retires, they actually have to contact the carrier directly, and they generally have a period of about 30 to 60 days to do that and work it out with the carrier to be able to essentially set up ACH, right? To be able to pay that premium on their own from their own account instead of the paycheck, right? So I think that ACH has that advantage in kind of preventing lapse with payroll deduction. You may see that folks forget or plain old don't want to take the plan with them when they leave, and that results in some lapse. And I think some of that lapse assumption is actually built in to the products when they're being designed. And ACH really helps kind of prevent that from happening. So those are the two ways that employees are generally paying their premiums. When it comes to employers paying the premium, employer funding, that also has two predominant approaches. So I would say the most popular is a list bill. So Premiums for everybody that's going to be funded and their benefit levels are kind of totaled up, estimated, and sent as a bill to the employer to be able to pay. It's the employer paying the premium directly. But with some carriers, we also see what's called essentially a salary gross up. Okay, so it is actually on the employee to pay the premium for the long-term care plan, and then it is on the employer to essentially bonus the employee or raise their salary to the amount of premium paid. And I think both are perfectly good approaches. I think that um, in the case of a list bill, or I guess the absence of a salary gross up, what you have there is you really have no choice. I am going to pay for this plan for you as the employer, and you are going to, have this policy unless you're speaking up with certain circumstances where you just will not take the policy at all. And with a salary gross up, it's really on the employee to actually go in, make the election, purchase the plan, go through the process entirely before the employer actually funds the plan, if that makes sense. So I think depending on who you are, there are different incentives there, right? I think list build generally just naturally helps to sort of secure more business, more participation upfront, right? Um, but there are some creative things you can do with salary gross up too. For example, saying, whatever you purchase, I will essentially fund or bonus you up 50% of the premium you paid. So there's a little creativity that can go on there. I think both are very interesting approaches, but again, I kind of like the one where the employee actually has to reach out and make a stink in order to, not have that plan. Everybody gets the coverage, right? So I thought that was a great question. I don't think we've ever kind of like, maybe we have, but I don't think we've ever answered that question from a general standpoint before. And that's kind of just at a high level how premiums are generally paid. And a lot of that stuff is really worked out just before kind of the sold group process. Yeah, Wen, go ahead.
Yeah, and typically, Jason, right? We get the question of what is easier for HR. So
Yeah,
ACH is much easier for HR
it
than having
is.
to deal with that. So that's always in our conversations that we've had.
100%. Yeah, the payroll deduction process, depending carrier to carrier, can, be a little cumbersome, right? HR's got enough to deal with. So I think a lot of the times you see a sigh of relief when you say ACH is available, is possible, and we're starting to hear groups ask for it proactively, which is pretty awesome as far as I'm concerned. Um, and that's really why we like it so much, right? We want um participation, obviously, but beyond participation, we want utilization. And for many long-term care plans, there's not going to be utilization unless you can take the plan with you after your working years. We get on webinars all the time, Wendy, and talk about how long-term care can happen at any age, but there are still averages that are being played and that exist out there, and the average long-term care claimant is going to claim after their working years. So to offer this benefit and really not have it taken with you, well, we want to try to stop that at all costs if we can. But on the other side of it, the carriers also have a certain amount of lapse assumption built into the plans. So I think it's a really kind of interesting thing to take a look at. And as group plans continue to mature, as more carriers get into the spaces, there's more empirical data to look at. We'll see how that may affect the pricing of group long-term care plans going forward if ACH is to be offered, or if there are certain terms that carriers will require, in order to offer ACH.
Hey, Jason, I was going to ask you too, with the companies and businesses that you're working with directly, are you finding that they are pushing, not pushing, but when they are doing the list bill, they want to be billed monthly? semi-annually or annually? Because I see it all across the board.
You know,
What
Wendy, to
do
be
you think?
honest, it's not something that I am getting into in my discussions all that often. Thankfully, we have folks on our team and otherwise, like account managers that we're working with who are very good at kind of, talking through those pieces. I think it really depends on the company itself, how they do business, how they're paying other bills of that nature, right? Um, it's a good question. It's just a question that's maybe a little over my pay grade.
Well, and I do the Mark answer. I say yes, and then I find out. But I
Yeah,
have been getting that more and more. Hey, the list bill, can it be done monthly? Because that's how we pay our other benefits.
at the end of the day, carriers, even though it may not seem like it all the time, they're dying to be flexible when it comes to employer facing things. They are really kind of falling over themselves whenever they can to be able to make this fit with all the other benefits, right? Because I get inquiries from people saying, "Hey, this group had a bad experience with XYZ carrier because they couldn't get the right amount of information on the list bill or it stuck out like a sore thumb in the way they needed to administer it from all their other benefits. So they're looking to do something new." I actually got one of those 2 or 3 days ago from somebody who inquired about a group. And they were like, they just dropped this plan from this carrier because of XYZ reason. So um, I think that's pretty common. I think that's why carriers are looking to just like make it work. And that's why your implementation manager on your first case or on your like first kickoff meeting when an enrollment starts, that's all the questions they're asking, right? How do you do XYZ, right? I want to do it exactly that way. Good question. Now, this was a hard-hitting question, super good one. Um, do you ever get uncomfortable with the fact that group plans may leave people underinsured, given that these plans lack inflation protection, maybe the individual market can offer a bit more robust benefits. And it's a great question. Sometimes the employees on webinars actually ask this question directly. Wendy, we were on a webinar yesterday where this came up. Um, is this enough coverage? And it's a good question. Um, I don't get uncomfortable with the fact that this is going to leave people underinsured, plain and simple. I am super comfortable with the fact that this is going to get somebody who potentially may not end up insured to be insured for a number of reasons, right? Like they didn't have any exposure to long-term care education. We're getting them at a younger age so they can get a plan, before it's too late, heaven forbid something happens down the road. But also there are people who want coverage who cannot get it on the individual market or by other means because of health conditions. So, in many ways, I think it is far more important, far more common that group plans are actually getting people a plan who otherwise would not have one or would otherwise get one far later down the road, right? I think that's the biggest appeal. Um, but that doesn't go without um, educating that you may need more coverage, right? As much as I give my first part of the answer, we do educate on the fact that, hey, listen, for many people, this is a starter plan and it may not be a one and done. It's great that you're able to access this benefit affordably. You may even have a portion being paid for you by your employer. That's awesome. That's about as good of a first time access to long-term care as you can ask for. But especially if you're younger, we're going to be looking at needing care 10, 20, 30 years down the road or more, right? And if the plan doesn't have any sort of inflation protection on it, you know, we know the stats on the cost of care. We educate on the cost of care. We educate on how costs are projected to increase even 30 years down the road as part of our webinars. So we do talk about the fact that Um, planning with some sort of long-term care specialist at some point. You don't have to necessarily add to the plan that you're getting through your employer today, but it is worth that conversation. But it plants the seed in the mind of, oh, I've done something now. I know what long-term care is. I've taken a step to protect against it, but I may need to do more because I saw those scary numbers on the webinar. It's not necessarily our purpose to scare, it's our purpose to inform. But those people, I have optimism that they will end up talking to a long-term care specialist at some point to be able to add on coverage, right?
Not only that, Jason, we talk a lot about the holistic plan because when you and I do our webinars, and even when you and I are talking with HR and advisors or agents, I mean, we talk about at least it gets it in their head that they have got to do something. It may not be the be all and end all, and it's not, but at the same time, it does create a conversation that they should have with their spouse, that they should have with their family, because insurance is just one little piece of it. You still have family, you still have your own monies, and it kind of lifts the weight I see in our webinars off their shoulders. It's like, oh, yeah, you're right. There are other things we can do in addition to this. And to your point, add on with an individual policy. Most of the people that we work with and that are really excited on the group is the guaranteed issue because of everything that we know about guaranteed issue. But the group side also is financially feasible for most people, for most employees that we've found. So
Yep.
it's both really.
Yeah, yeah, and you're hitting them at the right time where you're able to get them something affordable and fits their budget now. And then when that seed is planted, as income may allow or as assets may allow, they're more open to that conversation about protecting specifically for long-term care. So couldn't agree more. I haven't looked at the chat. Let's
Jason, yeah, there's a question.
mm-hmm.
A couple months ago, you shared a verbal list of businesses that are prime prospects. Do you
Yeah.
have that?
Super good question. I can't remember all of the verbal list off the top of my head, but there are certainly really good candidates. So
Doctors, lawyers, dentists, right? I
yes,
mean, those are like the three big ones, and they
white
are
collar trades are generally very good.
totally.
I'll give some reasons as to why. Um, when we think of law firms, for example, there's generally this group of partners who are interested in inter-partner benefits being, really, really strong, especially if they want to attract a new partner. Maybe a partner is going to be leaving the firm. They want to make sure their benefits package is really strong if they're going to try to entice a new partner. That's a big one. And that's really kind of like something that lays the groundwork for a nice employer funded case. And generally, there are other employees too, like office staff or other junior attorneys, who may be interested in the coverage as well. But that, partnership group or C-suite really helps move the needle there. Um, like doctors, I think medical profession in general can be a really good fit. I think I've seen some good interest and I would say traction from hospitals. And that's really another thing about it is like employer funded cases can be a draw there as well. You may not think of it that way because you just think about like nurses and like the general populace, the staff outside of like the care team at hospitals. But a lot of hospitals actually have rotating doctors. Okay, so there are doctors that could really go between like 1 to 4 hospitals and generally do as they're needed, but they can kind of pick and choose where to stick around if there's not a specific necessity. So I think a nice employer funded benefit for those rotating doctors, that's a big kind of attract and retain sort of market. I also think hospitals, um, in talking to them more and more, actually have executive staff who are interested in employer funded benefits as well. I just think the medical field in general has a lot of attract and retain incentive. Um, In that conversation, though, some hospitals, some medical professionals really, really get the concept of long-term care. And if they don't as much, I think it's as simple to educate as saying, you work with folks who deal with chronic conditions, comorbidities, all of the time. And you're dealing with them for their direct inpatient care or their outpatient care, whatever it may be. But long-term care is really how the family puts the pieces together when they leave your office, when they leave your hospital and they go home and need somebody to take care of them around the clock. I think that really just kind of helps turn the key on the education. So I think that's a really good sector to look at. But also, don't sleep on not-for-profits. People hear the word not-for-profit and they're like, oh, there's no profit there. Why would I ever? There's not going to be any money to do any sort of planning. It actually can end up being quite the contrary. The thing about nonprofits is that they have to essentially draw their profits to zero if they have any, right? So a not-for-profit that's doing really well actually at the end of the year has a scramble. I need to do some sort of planning so we're kind of breaking even, right? So that budget could be used for an employer-funded benefit, right? At the end of the day, that kind of excess. So I think that's pretty interesting. Um, Wendy, what about you? Actually, one more before I pass it over to you is, groups in finance, in insurance
Yeah.
are huge opportunities because number one, I think if you are looking to sell group long-term care and you are an employer, you have employees, it's a great way to see how the process works from start to finish to actually look into the planning process for yourselves. But also, other insurance organizations out there are kind of thinking the same thing. And a lot of the times it's like, I want to eat my own cooking, right? We're going to be doing a plan for Buddy INS employees here in the next month or so. It for the same reason, Um, we want to be able to kind of understand the decision-making process for ourselves. It's the first time after all of this educating that I've done on group long-term care, all this learning that I've done about the products, I actually get to go through the decision making. So what am I gonna buy up, right? Am I gonna buy up? So it's a pretty interesting scenario, and I think um, insurance financial organizations are really good candidates there. But Wendy, any others you have?
Yeah, I think the healthcare agency. I'm working with a great guy who's also on this call and always on this call. Home healthcare agencies. It's not for everyone, but I mean, we have great experience with two that we're working with really terrifically because they're in it. They see it every single day, and yet they don't have individual policies, and now they've got that opportunity on the group side. And that being Citus, that particular one, Jason, in California, gives them everything that they don't get in any of the other states, right? They got that inflation factor, and that matches out with on individual policy and actually comes out quite a bit less expensive. So I think home health care agencies, maybe not the individuals providing the care, but certainly staff and certainly owners that we're seeing.
It's huge. That one's kind of the elephant in the room, right? Because um,
So obvious though,
how
right?
how do caregivers like to be paid? They like to be paid with private dollars.
Yeah.
And how do we get people to come up with enough private dollars to be able to pay caregiving organizations? It's through insurance, right? And caregivers are obviously the ones who run toward the fire, so to speak, and are always willing to be able to provide that care to others. I'll get to that question in a second. Be able to provide that care to others, but they're also interested in, however possible, to break the chain, right? If they can keep somebody from ending up in a scenario where they're trying to put the pieces together and they just can't afford enough professional care, if they can put a stop to that for the people who are closest to them, who help their businesses move forward and help their dreams come true in their business lives, of course, that's kind of a no-brainer. So I would say that is some of the tops, white collar firms. I really like hospitals, the medical profession, and the financial field, but don't let that preclude you from looking at any other groups because you just never know who you're going to stumble upon in your network who has a reason to do this one way or another, right? Let's see. Who do you go to for groups based in New York? Yeah, Chubb just came out with a product in New York, so we're going to have more details to share on that soon. But Transamerica does have a plan in New York. Trustmark has 7702B long-term care in New York. Trustmark and Chubb are going to be a bit more limiting because, they're going to be looking at 100 employees plus at least. So Transamerica, if you have small groups, that's going to kind of be your way to go there.
Jason,
Um,
are they both employer groups only?
it's a super good question. Employer groups only. I would say New York associations are just going to have a tough time in general, kind of
Right.
limited on product, and the product actually has to be filed for each individual association. So when you put filing and New York in the same breath, it's like a train wreck. So I would say not impossible, difficult though.
Right.
Difficult.
Okay.
Um, that helps me transition into another one of the questions I got emailed, just about associations in general. I have an interested bikers association. Is that an opportunity that's any good? I would say, unfortunately, probably not. And the main reason for that is that carriers still, even if they're willing to consider associations, they really need that kind of like actively at work component. And one of the ways they kind of secure that, so to speak, with associations is making sure that associations they do work with are based on common employment, right? So it's an association on the basis of occupation. So a bar association, um, you know, an academy or association of physicians. They are in certain cases still willing to look. They're always willing to look. They want to explore. They're looking for good opportunities. But at the end of the day, I think something like a bikers association is just so loosely affiliated that it's probably going to have some issues. But that doesn't preclude you from going out asking the association good questions, especially do you offer any other benefits to your members? And if they're all of a sudden starting to offer traditional benefits like disability, health or supplemental health, life insurance, that at least gives some evidence to a carrier that, hey, they've successfully implemented benefits before. Let's dig a little deeper. So I don't ever want to tell somebody flat out no. I don't want to get anybody's hopes up irrationally. So I hope that was the right down the middle answer that I'm trying to give on that one.
So one of the things I wanted to add on that, I was approached months ago, back in February, because my husband had a business with Greg LeMond. So Bernie, for all the years that he was at Stairmaster and also at Le Mans Fitness, they use the biker dealer associations, which are big in the country. Now, I mean, not big like hundreds of thousands, but they run around 3,000 members. The difference in why I kind of put the brakes on it, along with Mark's help and talking to my husband and Greg, is they're very young within that association and they don't stay in that association long. So they come and go. So to what we always talk about, when you have a policy and then you leave and you don't take it with you as you age, it's kind of a factor. But we stayed away from that for basically that reason. They're
Yeah,
just members are young, they come and go, and the dealers are pretty young. They're like, the ones that own these shops are like 35 to 45 years old, and there's just not enough money to go around to pay staff. And usually their staff is 2 or 3 people on the floor.
And let me give another reason as to why the kind of professional nature of the association is preferred. Many times these professional associations have internal insurance organizations or internal support organizations, whatever you really want to call them. They go by a bunch of different names, but their affinity with the association is that I go to my association arm for my, you know, professional liability. I go to the association for my E&O. I go to my association for group health plans to be able to offer to my employees. So I have a very specific reason that I am interfacing with the association often, and that is to actually get benefits, right? More loosely affiliated associations generally do not have that sort of relationship. Sure, there may be certain benefits that are offered, but they're generally not in the way of employee or association insurance or financial benefits. So I think that's why they are generally going to stick to professional associations, because otherwise it's pretty tough to actually be able to reach everyone. It becomes more and more just like trying to reach a pool of individuals and offering them a group plan, which there can be a lot of issues with at the end of the day. So it's a super good question and always ask. Again, there's no silly question, so I appreciate the ask on that one. And then I have one more question that came through via email. What's the major difference between the popular group plans today? I saw that and I said, boy, what a question because it's so general. Um, I guess I can go over a couple of differences. Number one, the big difference you're going to see between a lot of these products is the chassis that they are on. You're actually not going to see major differences in the type of coverage. You're going to see, you know, life long-term care hybrid plans with extension of benefits riders and restoration of the death benefit. That's like the plan design that has them all looking so similar, right? But the difference could be the chassis, right? So that's one of the things that we're seeing being really creatively done in the space right now. So whole life, universal life, or term life, either to age 100 or age 121 are the chassis that we're seeing out there. And there are various different ways to, plan design within those. But I think otherwise the major difference really rests on underwriting, um, because every carrier really has different offers they're going to give to different groups. Some carriers won't offer to certain sectors, right? Chubb and Trustmark are not going to take a 20 employee group in almost all cases. Um, so we really do see that divide between Transamerica and Allstate and Chubb and Trustmark. Um, Everybody will take big groups, right? You give me a 20,000 life group that's really well qualified and has great demographics. You'd be hard pressed to see a group carrier that wouldn't take that group on. But underwriting as far as their general parameters and what offers they're going to give to the same group. That's why we're shopping these and comparing with as many carriers as we can, because carriers just have different views from an underwriting perspective on the industry, on the demographics. They value certain things more than others. Are they willing to enhance benefits for employer funded plans or for adding one or two more lines of business to the offer, right? That kind of in between, their willingness to negotiate, that's really kind of a major difference maker. And of course, um, these carriers all file their products just a little bit differently. So a lot of the difference is in combing the contracts and really understanding how each plan works. Are we dealing with a, true 7702B long-term care rider? Are we dealing with a chronic care rider that reads exactly like 7702B but isn't filed that way? Are we looking at a true chronic illness rider? That's where a lot of the differences are, and then plan design state to state. So a lot of the tools we made were really kind of to help you tell the major differences, like the Product Buddy tool does. Those are the major differences we see now. We're going to see a lot more variation over time.
And Jason, too, with the Product Buddy tool, immediately it tells you what state you can get that in anyway,
Yeah, it's my
right?
best friend.
And yeah, and that is super helpful because what Utah has, Texas doesn't. So in all those carriers, and that's where I go to first
I'm
until my
getting to the point where actually before looking into Product Buddy, I can tell you in certain states like
yeah.
what are you gonna end up with, but that's what the tool's made to do. The more times you actually go in there and interface with it and use it, you'll start to
So
know
good.
this like the back of your hand. It just speeds up the process of getting the initial answer, right? That's what I love about it so much. Um, so that was all the questions I got via email. I really want to open it up to the group. Do you guys have any other questions? I know some people have been typing questions into the chat, and thank you to everyone who helped with those and were my eyes. But I would love to just give everybody a chance to unmute and ask any questions that they have, or use the raise your hand feature. But if we don't have any questions, I'm gonna ask Gretchen a question. And you don't want her to answer it. No, I'm
Okie
kidding.
doke. Fire away.
All right. So um I get a lot of inquiries around like it's so funny because I can empathize with these folks because sometimes you just don't know where to start with a new subject. We were all new at group long-term care at one point. And I get, when I'm just starting out, what are some general things that I can just communicate about the importance of group long-term care? And kind of given your, I can answer it from the sales perspective too, but just from a marketing and communications perspective, I know one of the big things you really focus on is getting people from just finding out about long-term care to the finish line. But how do you kind of spark that?
Oh, that's a good question. But I mean, you really have to, first of all, you have to understand uh, where the audience is as far as their knowledge of the need for long-term care. So I think somebody mentioned a younger audience. So it depends on their age, because a little bit more mature audience might have more of an understanding of the need. So you can kind of skip over that to some extent and go right into product.
Yeah.
The younger audience is going to need education. So we lovingly call it our journey of discovery, where you're really starting at zero and you're trying to go 0 to 50 in 30 days, which is not easy. So, you really have to tune into your audience. The other thing we look at is it a more technical audience? So they're more analytical. So like your tech companies, you may you may have a little bit of a different message focused on the calculator, and that gives them a chance to really play around with the cost versus the benefit and dial it up, dial it down, and they love that. So, what I would say is the just the general rule for like the broadest sense is that journey of discovery where you're taking them from I have no idea why I need this, why are you even proposing this to me, so you're taking them from that to several steps in that journey to educate them on the need.
Yeah, and that
And then
lines up with the sales side so well because the first thing we're generally saying is designed to find that out for
right,
you down the line and for ourselves, of course. But it's really like, well, we're sitting here. You've come to this meeting and you're here to talk about group long-term care. You know, what's the why behind that? Like, what's got
right,
you interested in
right,
long-term care in some way, shape, or form that you've ended up here? on this Zoom call with us, right?
Right, right,
And
right.
they'll give you what you need there.
And it could be, if you're in an enrollment where you're working with an organization that might have an enrollment, open enrollment this year, and then another open enrollment next year. And a lot of times you're not going to do all that well in that first phase, but you just continue, even between the enrollments, you continue to drip information to that group, and then with the goal of improving engagement in the next go around. So I know Claude has his hand up too.
Yeah, yeah, go ahead, Claude.
Um, First of all, I just want to compliment you. You do a wonderful job on these webinars.
Thanks.
I haven't been on for a while, so I missed the one where you guys discussed American Heritage Life, but I'd be interested in some questions about that, but that may be too specific for today since you
No, no,
seem to
go
be
for
taking
it. There's
it.
nothing off limits. Go for it.
So, it's interesting. You get these proposals, and they oftentimes don't tell you enough about the product. Have you reached a conclusion that the American Heritage Life elimination period is a repeating elimination period every time you have, if you go 180 days, uh, it'll start again? That's what it looks like to me when I read the writer, but the group proposals they give you don't say that at all.
Yeah, that's a super interesting question. And to me, um, I I actually am not entirely sure. The language is very open to interpretation. I know we've had our fears allayed about that by the carrier, but at the end of the day, it's right down to the contract language. Um, I haven't
So the
under
carrier told you that it's not a repeating elimination. I've asked them and they haven't responded yet. So, but they told you that it's a one-time elimination period.
the conversation was a while ago. Um, And I believe so, but I can actually, it makes me want to triple check, and I've triple checked so many things around the product before that I don't want to give an incorrect answer. So I'm going to triple check and I'll provide an update on that to the group.
I will say that I've gotten wrong answers from them on that product before. For
Yeah, it's
example,
tough.
I was assured that it was a 34-month benefit period, just like the proposal said. Absolutely have it in writing from them that's a 34-month benefit period, but it's not. It's a 33 and a third month benefit period. So, you can get wrong information. Curious, have you guys discussed the mental and emotional disorder exclusion that they have in almost all states?
We have discussed it a bit. Um,
Okay.
and that one is pretty interesting, like it's a really interesting discussion around what defines a cognitive illness, right? Um, and it's generally a bit more kind of taking like an Alzheimer's and dementia and saying this is, cognitive disorder and that's that, right? Um it's that is really why we kind of comb the contracts because even looking through the contract, look at the elimination period language itself about, obviously there's a 90-day elimination period, but look at the language in the contract and make a solid determination of whether it's a calendar or a service day. And it's hard to come up with an answer. It can be interpreted both ways, right? And so we've asked a couple times on that, and we're pretty sure it's calendar. Um, but it is tough, to like actually comb those contracts without a ton of empirical claims data behind it, right?
Well,
Um,
that's really interesting because the wording in the contract, there is wording in the contract that I think makes it clear that it's not a calendar day elimination period. It says you have to incur a qualified expense.
yeah, one time. I mean, at minimum one time.
Now, that's once you're in claim status. Once you're in claim status, if you have one qualified event a month, you get half the benefit. If you have if you have qualified expenses on 2 days, you get the full benefit. But if you the when I've read the elimination period wording, the, yes, it depends on where in the contract you look. It can be confusing, but there I did find wording in the contract. I'd have to find it, and show you. But I became convinced that the elimination period you had to have a paid service each day.
So let's compare notes on that
Yeah,
and let's get
yeah.
the real
We can do that
answers from the
offline if you
source.
want.
Yeah,
Yeah.
yeah, I'd be happy to do that. But yeah, I think it's just like a good general discussion that there is a lot to figure out when you're going to offer these plans. And I wouldn't let that necessarily discourage you from offering group long-term care, but you have to be able to represent things properly, right?
Mhm.
So you really have to have those good carrier relationships to be able
Mhm.
to double and triple check everything, right? Because
Hmm.
you're right. I think a lot of these organizations, some of these organizations are new to offering long-term care. That means all of their salespeople are new to offering long-term care. So we actually have to talk to the Claudes of the world who built the products, and really get answers from the horse's mouth as they come up. Yeah, good point. Good questions.
Thank you.
Anybody else have any questions that they'd like to ask about anything group long-term care? We are here for it.
Sure, I got a question.
Yeah, go ahead, Steve.
I'm curious as to you may have mentioned it before. What is your average annual premium per participant? And is that impacted by whether it's employer funded or partially employer funded or not?
So Mark, I know, knows the answer to this right off the top of his head. I know our average premium is much higher and than, the industry average.
Mhm.
Um, I think the industry average is, you know, under 1,000 a year. I believe we're north of a couple thousand a year.
Really?
And I think there's a couple of factors that really speak to that. Number one, it's like the amount and quality of education and communication and sales decisioning tools that
Mm.
help with that. Oh, I actually like the value of what I'm getting. I can
Mm.
see the value of what I'm getting right in front of me. I can see the premium really transparently in front of me as I'm kind of going through my decision-making process. It's not just the slider in the enrollment platform where I'm seeing it for the first time. I can actually check all the cells for myself easily.
Yeah.
But I think employer funding has a huge amount to do with it, and it doesn't necessarily need to be a fully employer funded benefit. As a matter of fact, like let's say a group wants to do, say, a base plan and no buyout. I just want to make things super easy. Um, that tends to be actually kind of low average premium from that perspective, right? There's not really the
Mhm.
opportunity to buy up. That's why we really like the base plus buy up. And I think that really results in a higher than average premium. I think psychologically, it is much easier to go from having something purchased for me to purchasing a little more than it is to go from nothing to something, and I have to dig into my own pocket to do that.
Mm.
So I think that has an effect. People who are funded are much more likely to buy up, in my opinion. And I also think that even if they're doing some sort of carve out or a base plus buy up for a specific group of employees and voluntary for the rest, I think that spreading of the word and, the really influential people in an organization being pre-educated actually goes a long way, to spreading that word to their peers.
Mm.
So I think those are like the major reasons why we see a higher than average premium.
Mm. Okay.
But, there is an argument for simplifying things as well. you know, we've had to kind of dial things back because we're looking for a happy medium there of like average premium. Of course, we like to have a high average premium, but average premium and participation, right? If only the kind of top end is participating, it can still be a good case, but in whose eyes, right? We do want to be a good partner for the carriers. And I think keeping things simple and keeping things within people's budgets, we dialed back the defaults on our calculators, for example, to say, hey, buy what you can afford, right? Buy what you can afford. That will get people to participate. It'll bring your average premium down a bit, but more participation is really also a huge, huge goal of ours at the end of
Mm.
the day. So hope that's helpful.
Yeah, yeah.
David, go ahead.
Too, Steve, we have so many young people that are employees, right? That are that 35 to 45. And our average, I think right now, Jason, average employee is like 44 years old. So the opportunity for them to buy up, because it literally is dirt cheap for a 40-year-old.
Mhm.
Really, we're talking $32 a month. So they look at that and go, okay, maybe it's only $25,000 death benefit. Maybe it's even a $50,000 death benefit, but it's so attractive that they do buy up, to Jason's point. Um,
We
anyway,
do
I just
see folks in their 60s that buy too, and that's where the
totally.
pricing really goes from this to like this on the
Mhm.
curve.
Sure.
So that has something to do with it as well, I would assume. David, go ahead. Thanks for being patient.
Yeah, no problem. The question I had was if the employer said, "Oh, I'll pay a base plan if and only if the employee buys up." In other words, I'll give you a 25 and 12.5 on the life, but you have to buy 50 and to do it, or 100 or whatever it might be in long-term care insurance. So if you don't buy up, I won't pay the base, but if you do buy up, I will buy the base. Can they do that, or do they do that?
That's interesting. I don't normally see that at all with like like a list bill. I don't know since I haven't seen it before, I can imagine a world where you may be able to craft those sorts of logistics with, list bill premium payment, but um I just wouldn't know myself. But I will say for those employer funded plans that are a salary gross up, it almost automatically ensures that. Like I'm going to fund 50% of what you purchase in the form of grossing up your salary. So it's almost kind of built into that sort of program. You can also say like I will fund you for whatever you purchase up to 50,000, up to 75,000. So I think there's an interesting bit of creativity there, but it is, yeah, dependent on the employee to purchase something before any of that happens, right? Because the employer is actually doing the funding on the back end of the purchase. So,
Because the employer's looking at it, if it's not motivated, why do it?
right.
It's not encouraging. So why put money out there if the employee really isn't seeing it as an added value?
There are
If they see
absolutely
it as an added
employers who see
value,
it that way, and there are some who say, I want to just use some golden handcuffs, right? At the end of the day, like you're going to own this thing, and I'm going to educate you on how important it is. And, hopefully you'll come away from that education appreciating what I've done.
well, I come away, then you're telling me that no one's done that.
Uh, from a list bill product, I have not seen it, but I have seen
Okay.
it with carriers like Allstate and Trustmark who actually go by that salary gross up. I have seen a group actually come out and say, I will fund 50% of whatever you purchase, but you gotta purchase. I would say that specific group that I'm thinking about, the participation wasn't as high as I thought it would be, to be quite honest. And it started to get me thinking about, hey, there's benefits and drawbacks to this, right? The employer minimizes their exposure on the funding side, but from an overall participation, you're not going to get as much participation, obviously, right? Just funding a base plan for everyone, you got no choice. I'm paying for this. I'm getting a bill and I'm paying it. Um, that is guaranteed participation.
The thought I'm thinking of is, say they buy a base plan for an executive carve out for everyone,
Hmm.
but then they do a voluntary. And on the voluntary, what I'm looking at is if you decide to buy something, I will pay a base pay and then you pay the difference.
I
That's
think
what I
it's a
was thinking.
strategy that could work. It's kind of like an employer match, right? In
Right.
another benefit like
And that's the thought I
401k
was
plan.
thinking of.
Yeah,
Right.
yeah, it's really interesting. And that's really where I kind of see it as like I'll fund 50% in those salary gross up cases is um about the closest I've seen personally, but I think that's something worth exploring, to be quite honest. It's just a matter of working with the carrier to say, this is the type of program the employer is interested in. Can we do something like this?
Totally
I
agree.
think,
And having that relationship with that carrier, and we all have it. And I think that is key because you can pick up the phone and ask them that before you go down any other road and present it to that employer. So you can have your ducks in a row and you can get the okay or the not okay. And then like then you
Right.
know.
Yep.
well, Wendy, I think we have a case that I'd like to know
I
on that.
know, my friend. I know. I think this is good.
Yeah, I would say at the end of the day, um, we're in an industry that is not new, but it's returning and it's new since it's returned, right? So there's a lot of untread ground, a lot of things to be able to explore and find out. And sometimes it just takes the right carrier partner.
Yeah, I have several group cases that we've done in the past, but this was 10, 15 years ago, and they're very, very different on today's products. So
Yeah.
much better, in my opinion.
Yeah. Very, very interesting and um, innovative structure that is based on, um, you know, product types that have been around for a while. And we're going to see more of that. We're going to see more innovation. We're going to see different product types coming into the fold, I'm sure. Question is just a matter of when. And we'll be here when it does. And we're at the top of the hour. So I really appreciate everybody being here. Tons of good questions. Thank you to those who emailed me in some questions. That was super helpful. I think it was a really good learning experience, all those questions that were asked. So appreciate y'all for doing this. It still kind of blows my mind that we can get sort of any crowd when I hold a study group that's just ask questions, right? And people show up and ask questions and um, just a really surreal feeling. So I appreciate you all for making these calls what they are. Be well, and we'll talk to you this time next week. Have a good one, everyone.
Bye.